Now let's look at credit spreads. So the government bond sets the benchmark for interest rates, and then all the other issuers that are not the central government or anyone who can't print money, they have a credit spread based on the rating, the credit rating that's given to them. Remember, the credit rating was given by credit rating agencies like S&P, Moody's, and Fitch, who all have subsidiaries in India, so CRISIL and so on. So these companies go into the issuer, look at all their financial statements and operations and say, this one is AA, single A, triple B, and so on. And then the market then prices how much each of these buckets, AA, single A, triple B, should sort of yield over and above the government bond. So the government bond, say, is yielding 5%. A AA, which is lower than AAA, may be 30 basis points more or 50 basis points more. So that might just be 5.3 or 5.5. Triple B might be 300 basis points more, so 3%. So if government bonds are 5%, triple B might be 8%. These credit spreads vary, okay? They vary based on the business cycle and what the market perceives the economic conditions will be like. So sometimes they tighten, which means they come in, they come down, and sometimes they spread out, which means investors want a higher return for taking on credit risk. So the fund manager's job is to predict how the market will price the credit spreads and how it will change as interest rates go up and down. So just like in the yield curve, the long side and the short side might behave differently. Similarly, on the credit spectrum, the investment grade and the non-investment grade bonds behave very differently, and it's the fund manager's job to predict this. If they get it right, their returns are higher. If they get it wrong, their returns are lower.